Hello, ladies and gentlemen. Welcome to EQUATE Group's earnings webcast for the year end of 2020 financial year. Today's webcast is being recorded. Please note that the historical and current performance data in this presentation are not necessarily indicative of future performance. I am Wa'il Allahu, and I will be your moderator for this webcast. I am joined today by our President and CEO, Mr. Nasser Al-Dosiri, Senior Vice President, Mr. Sudhir Shinoy, Chief Financial Officer, Mr. Fisanu Sherm-Chai-Wang, and Vice President Operations, Mr. Gonzalo Beltran. This webcast will be followed by a Q&A session. At any time during the webcast, you may submit your questions through the Ask a Question tab. We expect this webcast to conclude in 30 to 40 minutes. After this call, the webcast and presentation will be available for replay at your convenience through this same link. Both the presentation and webcast will be also shared on our website under the Investor Relations section. With that, we will now start with our CEO and President, Mr. Nasser Al-Dosiri.
Thank you, Wa'il. Hello, everyone, and thank you for joining us today. On behalf of the EQUATE Group, I hope that you and your families are healthy and safe. First, I would like to take this opportunity to welcome two new executive team members who joined us at the end of last year. Mr. Sudhir Shinoy, our Group Senior Vice President, and Mr. Fisanu Sherm-Chai-Wang, our CFO. Both have transitioned well into their respective roles since October last year and bring a wealth of experience and knowledge to the organization. We are committed to keep our DCM investors informed and updated with the latest information. Today's presentation will start with an overview of global markets, EQUATE Group's financial performance for the year ended 2020, followed by a detailed financial review of our financial position, cash flow, and profitability by our CFO, business and market highlights by our Senior Vice President, safety and sustainability updates by our Vice President Operations, and lastly, a Q&A session. As you are aware, EQUATE Group is a joint venture between Petrochemical Industries Company and Dow, with each holding 42.5% of the group. In addition to Bobian Petrochemical Company that owns 9% and Crane Petrochemical Industries Company that owns 6%, both of which are listed in the Kuwait Stock Exchange. When we refer to the EQUATE Group, we are speaking of EQUATE Petrochemical Company and subsidiaries, as well as TKOC, the Kuwait Olefin Company. In slide 6, the health and safety of our team will always be our utmost priority, and the foundation pillars on which EQUATE is built and have enabled us to maintain our commitment to our customers. The EQUATE Group team delivered positive results in 2020 despite unusual market challenges. EQUATE has demonstrated resilience and flexibility in continuing operations safely and reliably. We will remain resilient, taking strategic decisions to enhance our competitive advantages and continue creating value to our shareholders. EQUATE Group remains the leading low-cost producer with a 100% sellout position of all of its products globally. EQUATE latest addition, the U.S. Gulf Coast plant in Oyster Creek, has delivered excellent record. and has exceeded its nameplate capacity by more than 20%. Despite significant global headwinds, EQUATE EBITDA margins are above 32% of sales due to cost control and market-leading positions across the group. More details will be shared throughout the presentation. Moving to the EQUATE Group overview in slide 7, I would like to share a quick overview of the group. We are a global manufacturer and marketers of petrochemicals. Our main products are ethylene glycol, polyethylene, and PET, polyethylene terephthalate. Our industrial complexes are located in Kuwait, Germany, the US, and Canada. Our total ethylene glycol production capacity reached 3.7 million tons annually with our new ethylene glycol plant in the US Gulf Coast. Our ethylene glycol production breakdown in 2020 was 36% from Kuwait, 32% from Canada, and 24% from the US and 8% from other regions. Our Kuwait complex mainly serves our ethylene glycol customers in Asia, the Middle East, Turkey, and the Indian subcontinent. Our facilities in North America serve customers in North and South America, as well as Asia. Our polyethylene is produced in Kuwait and supplies customers in North Asia, India subcontinent, Europe, Southeast Asia, Middle East, Turkey, and Africa. Our PET is produced in Germany to primarily serve the European customers. Moving to slide 8. EQUATE Group maintains its leadership position as the second largest producer and marketer of ethylene glycol globally. Our global ethylene glycol sales are widely distributed across various regions, with North Asia representing the biggest sales at 50%, followed by the Americas at 19%, the Indian subcontinent at 14%, Europe at 12%, and the rest of the world representing 5%. In slide 9, looking at our polyethylene sales by region, we sold 45% to North Asia, 21% to the Middle East, Turkey, and Africa, 19% to the Southeast Asia, 9% to Europe, and 6% to the Indian subcontinent. Going to slide 10, for the EQUATE Group's financial results highlight, we closed the year with a healthy profitability level despite the impact of the COVID-19 pandemic crisis on demand and prices. The industry is still navigating a challenging business environment with the continued pressure from compressed margins. Our priority is to maintain the safety and security of our employees, keep a close eye on cost management, maximize output, and keep our customers satisfied through a strong customer relationship and delivery of high-quality products. The reported results of the year end in 2020 reflects the combined results of the EQUATE Group, which consists of EQUATE and its subsidiary, as well as TKOC, the Kuwait Olefin Company. Our revenue was down by 13% from 2019, mainly due to pressures on prices. This is also a topic that our Senior Vice President, Sudhir Shinoy, will be discussing later in this webcast. Our EBITDA was 945 million, down by 16% from last year's. Sales volume stood at 5.1 million metric ton, 11% higher than the same period last year due to the new Oyster Creek production facility in the US Gulf Coast. Our combined net income was 358 million. 44% less than 2019. For more details, I would like to hand over the presentation to our CFO, Fisano Sirmachaiwan, who will speak about our financial performance and financial position.
Well, thank you, Nasser. In the next couple of slides, I will take you all through our financial results for the year end 2020. Going through slide 12, let's have a look at our financial positions. Despite the pandemic situations and the price headwinds that we faced in 2020, we ended the year with strong liquidity and financial position. We had 733 million cash on hand, and our gross debt stood at 4.65 billion. That results in a net debt position of 3.9 billion, and our 2020 EBITDA was 945 million. Slide 13 highlights our cash flow for the year and our debt maturity profile. In 2020, our business generated 1.06 billion of cash flow from operating activities. We spent 217 million on capital expenditure and paid a total of 637 million dividend to the shareholders. With that, our free cash flow for the year 2020 was positive 214 million. Looking at our debt maturity profile, during the second quarter of last year, we successfully complete the refinancing of our 1.9 billion term loan by issuing the 1.6 billion dual tranche bond, the 5 years 2025 and the 10 years 2030, plus new 300 million bilateral term loans with local banks for a tenure of 3 years maturing 2023. In an effort to optimize the cost, we managed to reduce the RCF commitment by around 500 million through our strong relationship with banks, which in return led to a reduction of annual commitment fees by almost 50% and extend the facility by 1 full year until June 2023. As of the end of 2020, the EQUATE Group has a well-balanced net maturity profile with optimum cost and stability despite current market conditions. As you can see, the next debt maturity will be in March of 2022. Now turning to slide 14, let's look at our profitability. Our EBITDA margin was still at a very healthy level despite all the challenges we faced in 2020, exceeding 32% EBITDA margin. This was a true reflection of our low and competitive cost structure together with our operational excellence, high asset utilization, and effective cost management. EQUATE Group sales revenue reached 2.9 billion compared to 3.3 billion in 2019, and our EBITDA went from 1.1 billion in 2019 to 945 million. Finally, our net income for the year stood at 358 million compared to 638 million in 2019. Look at the revenue in more details on slide 15. EQUATE Group maintains strong financial and operational performance as evidenced by several metrics. We record a total revenue of over 2.9 billion, down by 13%. We generate 41% of our revenue from the North Asia region, 19% from Europe, 12% from Americas, 10% from Indian subcontinent, and 18% from the rest of the world. From a revenue by product standpoint, 62% of our revenue is generated from ethylene glycol, 23% from PE, 9% from PET, while the remaining 6% is from other sources of revenue. Let's take a closer look into our volume and average prices for the year 2020. From an EG side, with our new Oyster Creek operation running for the full year, we are looking for a sales volume of approximately 4 million metric tons, which is 13% higher than last year at an average price of $450 per metric ton, which is 21% less than what we had in 2019. From the polyethylene side, we sold 773,000 metric tons, which is 2% higher than last year at an average price of $850 per metric ton, which was down by 12% from what we had in the same period last year. Finally, PET volume was 319,000 metric tons at an average price of $846, which is 25% lower than what we had in 2019. And with that, I would like to pass on to our Senior Vice President, Mr. Sudhir, for a market update. Sudhir.
Thank you, Pisanu. Moving to the market update, slide 17. Despite significant headwinds in the global markets, EQUATE Group successfully continued its sold-out position, maintaining our operations at a high rate throughout. Additionally, customer demand continues to be strong in a resilient market, supported by our continuous netback optimization, leveraging our global footprint and our integrated supply chain. We have been continuously supporting our customers to immediately and effectively respond to the unpredictability in their demand pattern because of the pandemic. Moving to slide 18, looking at the market and the price trends of our products on slide 18. The market has experienced a trough that has been impacting the pricing on ethylene glycol and polyethylene. Average prices have fluctuated since the beginning of the year compared to 2019. However, price trends started to show signs of recovery by the end of last year and continue to strengthen as we speak. The company capitalized on the strong demand of polyethylene, delivered exceptional results, taking advantage of improved margins while maximizing volume and price. EG was challenged throughout the year due to unplanned lockdowns. However, EQUATE managed to maximize pricing and volume in high netback regions. At the same time, the polyester value chain remains resilient, and we see improvement in this industry. The group was able to navigate through this period and remained disciplined and proactive, maintaining our market position. We are also confident that the group can maintain its profitability and overall stability by leveraging our sizable, advanced, cost-competitive production capacity, high asset utilization, and a global distribution platform. We can't underestimate the challenges that our industry may have to face, but effective management and global capabilities and presence will mean that we are prepared, ready, and able to continue to manufacture and deliver products to our customers. On slide 19, we showcase our commitment to continuous innovation and sustainability to shrink our carbon footprint through our latest development, Viridis 30. Viridis 30 is a food-grade PET that uses up to 30% chemically recycled PET as a feedstock. The product reflects EQUATE Group's alignment with the European Commission's Strategy for Plastics in a Circular Economy, adopted in January 2018. The product reduces the need for virgin PET, which benefits the environment, business, and the community. The development of Viridis 30 is aligned with the EU's target to achieve 25% recycled PET in packaging by 2025 and 30% by 2030. We have already seen significant interest for this product ahead of its commercial launch in the first quarter of this year. Thank you for your attention on our market overview. Now I would like to hand over to our Vice President of Operations, Gonzalo Beltran. Gonzalo.
Thank you, Sudhir. On slide 21, as we can see, all facilities around the world continue to operate safely despite several external challenges. notably the global COVID-19 pandemic. I would like to take this opportunity to say that I'm very proud of EQUATE Group's achievement in maintaining high standards. We ensure EH&S, reliability and efficiency are seamlessly integrated across all our industrial complexes in Kuwait, Germany, and North America. We ran our plants at full capacity again this year, with asset mechanical reliability and production standing at almost 101%. We have achieved over 25 million consecutive safe work hours without a day away from work. We recorded 0.0026 recordable injury rate, 0 process safety and containment event, 0 motor vehicle accidents, and 0 notice of violations from regulatory bodies. And we are in full compliance with all environmental regulations. Going into slide 22, EQUATE Group continues to strengthen its commitment to sustainability standards through best practices and innovative products, such as the development of REDIS 30. EQUATE Sustainability Strategy 2025 consists of 16 initiatives identified under 3 core themes: build, innovate, and impact, and is mapped against the United Nations Sustainable Development Goals, more known as SDGs. In recognition of the group's focus on prioritizing safety and the environment, EQUATE is Kuwait's first responsible care accredited and certified organization, the international voluntary initiative of the global chemical industry to safely handle products throughout all phases. With that, I would like to hand it back to Wael Alahu, who will moderate the Q&A session. Thank you.
I thank our speakers for their presentations, and we will now take your questions. You may continue to submit your questions through the Ask a Question tab during the Q&A session, please. If now, please give us a minute to go through the questions, and we'll be right back. Hello, everyone. We're back with the first question, and I'll read the first question. Could you please provide CapEx guidance for 2021 and whether you have any plans of tapping the bond market this year? And our speakers... Yeah.
Cristiano will take that, our CFO.
Great.
Okay. Well, CapEx guidance for 2021 would be around 175 to around 200 million. Okay, and then that would consist of the general capital expenditure for maintenance, right? And with respect to the access to the capital market, I mean, we have about 4.6 billion debt portfolio on our book. I mean, we always keep close eye on interest rate and capital market development. I mean, we will definitely keep all of the investor informed at the right timing once we made the decision to access once again to the capital market. Yeah? Thank you.
Thank you, Cristiano. We'll just take a look at the other questions. 1 second.
Well, I'll take the second half of the first question on the capacity addition anticipated on the glycol and on the polyethylene. To answer that, we do operate our plants efficiently, and as we've indicated also in our earlier overview, that even our latest addition to the group, which is the U.S. Gulf Coast ethylene glycol plant, is running 20% above its nameplate capacity, and we'll continue to operate our assets to the highest capability levels.
Thank you, Nasser, for this. For answering the question. I'm just facing a bit of a connection problem. I'm reconnecting to be able to see the questions. If in just a few seconds.
So another question is as I can see it, and I'll start with just a caveat that we don't give any forward-looking view on pricing in terms of commodity pricing, but we've certainly, we've seen a rebound toward the end of last year, and prices continuing to improve. Sudhir, if you want to chime in on that.
Sorry, yes. I mean, obviously we've seen significant volatility in the marketplace. However, we've seen extremely strong demand from our downstream value chain, and we've seen obviously the recovery that we talked about early on in the presentation. While certainly there are announced capacity expansions that are expected to come on stream, some of them already there. We've still seen in the last quarter itself as well that the market continues to be very strong, and as you saw that we have seen significant recovery in the pricing in the last quarter. So we feel very good at this point in time.
Okay, great. I'm back actually with the connection. Thank you very much, Sudhir, for answering that question. The next question we have is that can you shed some light on working capital needs for 2021 and status under loan, and if it's compliant as of full year 2020?
Yeah, let me take that question here. I mean, the second part of the question is pretty straightforward. We are in full compliance of the covenants under our debt, right? Under our revolver, we don't have any covenants anymore. I mean, financial covenants, right? It's only a springing covenant that we have, which will come when we utilize the facility. Okay. On the first part of the question related to working capital needs for 2021, we don't see any drastic change or additional requirement versus what we're running in 2020. Okay? I have to say that we have been managing our working capital very diligently throughout, and especially also through the COVID-19 situations as well. So we are pretty much in control, okay, of how we manage our receivable and our inventory as well as our account payable. Thank you.
Thank you, Fisano, for answering that question. We have a question, I think, related to commercial. When do you expect new Asian supply to start impacting the market and prices to soften?
Again, from a forward-looking perspective, I'm not sure that we can provide guidance. There is obviously capacity additions. Some of it has already happened. Some of it we know have been announced to have been delayed. The market is seeing, I mean, we've seen a significant growth in market, especially in China. And during COVID, we have seen that growth has even accelerated in many markets because of, various factors, including very significantly higher e-commerce purchasing business. So we do see capacity will come up, but we also see that the market demand is strong. There's a lot of factors at this point in time that are difficult to foresee in terms of the timing, in terms of how demand continues to shape up, what kind of global recovery, what happens to oil prices. There's a lot of question marks which make it extremely hard to predict in terms of a forward-looking view.
Thank you, Sudhir. Okay, we have a question that I think that's more related to finance here. In terms of bond issuance, when should we expect you to tap into the market? Do you have any intent to issue a hybrid?
As I mentioned earlier, we will let you all know and definitely keep you all informed, okay, when we decide to go out to access the capital market once again.
Thank you, Fisano. Yes, so overall, as you can see, we have a debt maturity information that Fisano have presented, and accordingly we will keep you informed.
Thank you, Nasser. Thank you.
There's a question about the nameplate capacity. I think, Gonzalo, if you can just shed on how did we exceed the nameplate capacity in the U.S. Gulf Coast?
Thank you, Nasser. Yes, basically, whenever you establish a capacity nameplate number, I mean, you take into account some online activity, and we were able to run our plants for almost 365 days last year in Oyster Creek. So that's why we exceeded that, plus the fact that we always look for continuous improvement in our operations. So this is the result of it. Thank you.
Thank you, Gonzalo. And I think we have another question, which is probably similar to a financial question that we've had before, but just to make sure that we've covered all questions, can you highlight the CapEx plan for 2021 again, please?
Again, the guidance for your modeling purposes, I mean, you can use the CapEx approximately 175 to 200 million, okay, for the year 2021, yeah? And that's for your modeling purposes, okay? Thank you.
Thank you, Pisano. Ladies and gentlemen, we haven't received any additional questions. We now conclude this webcast for EQUATE Group's year-end 2020 earnings. The presentation and the webcast will be available on our website soon. Should you require further clarifications, you may contact EQUATE Group's Investor Relations as per the information on our website at equate.com. On behalf of EQUATE Group, we thank you for joining our webcast today, and we wish that you all remain safe and healthy. Goodbye.